Chapter 3 Advanced Business and Financial Management. This is a latest paper. Last from 2023 it has been introduced. So 2023 2 papers, 2024 2. So 4 papers, 4 times only the exam has been conducted. As you are aware, in CAIIB paper, they can even ask for you to work out the sum and input the answer. Not necessarily, they need not give any choice for you. Sometimes you are asked to work out the sum and input the answers there. So kindly listen carefully, particularly this module C first unit. There is a problem here, important problem. It can come in a case study also. So I request you to pay attention. I am in the group, your group I am already included. So in case of any doubt, you can ask me in the WhatsApp group, you can put your queries, I will answer. So at the end of each, each unit, I will be sharing PDF file with you. Kindly go through them. And also we will be giving some problems for working out at your end. So that will be easy for you to work out and then find out whether you have done correctly. So with this, we will move on to module C. As I said, module B and module C, they are having numerical problems. Module A and D are fully theoretical. So the first unit is on corporate valuation. So up to 12 we have covered. So unit 13 is corporate valuation. So this unit 13 is on corporate valuation. So corporate valuation, as we know, is the process of determining the value of a company, corporate, value of a corporate. It is mainly used for mergers and acquisitions. Whenever a company wants to take over another company, then in that case, they generally try to determine the value of a company. And this is this is not only by the companies which are being taken over by another company. Even the bankers who are lending to the company, the income tax officials, GST officials, they are also interested in determining the value of the company for various reasons. So the types of valuation, mainly there are 2 types of valuation. One is called the book valuation and the another is market value. So book value, as you know, from the books or balance sheet of the company, we know the balance sheet is there, the book value. Only the problem with this is that it is a historical value. So balance sheet value is a historical value. It may not reflect the true value of the company. So then we have market value or equity value. So we multiply the number of shares, outstanding shares, with the market price of a share. Also called, we call it as a market capitalization. So, but this values only the equity value. But if you want to know the entire value of a company, we call it as an enterprise value. So the equity value is different from enterprise value. So the enterprise value is equity value. This is market capitalization of equity shares plus the amount of short-term and long-term debts plus current portion of long-term debts. What is the current portion? When we say current portion of long-term debts, I request you to actively interact so that it will be easy for me also. What is the current portion of long-term debts? Suppose repayable in, let's say, 7 or 8 years. What is the current portion of the long-term debt? In 12 months, within the next 12 months, this balance sheet to next balance sheet. So the current portion of long-term debts. Why we are segregating this long-term debts, the current portion from this long-term debt is because it is a short-term one. So we want to know how much short-term debts are there, how much long-term debts are there. Plus preferred securities are preference share capital. Plus other non-operating liabilities, where there may be other liabilities, liabilities owed to outsiders, etc. All these will be taken into account. And from this, we minus the amount of cash and its equivalents. So cash, its equivalents, by equivalents, we mean the some investment is there, some investment from the cash is made, short-term investment, that also we take into account. So we call them as marketable securities. So cash and marketable securities. Why do we minus the amount from this one? Why do we actually reduce this amount from the all these? Why at all we should minus the amount of cash and cash equivalents from the total value to arrive at the enterprise value? Why we are from this liability? Why we are reducing the asset? That's what the question is. Net worth is liabilities minus assets, or equity minus intangible assets? What is the net worth? Net worth is actually only the capital plus resource only. Only tangible net worth only. We say by T and W, we say net capital plus resource minus all intangible assets. We do it. But my question is why we want to reduce the cash and its equivalent. Suppose, let us say there is a suppose some this cash represents what? Short-term assets, short-term other assets may also be there, but it actually, some portion of the asset has been liquidated. So if we take the cash again into, it will mean double counting. So to avoid double counting, what we do, we for the equity value or enterprise value, we add equity plus all short-term and long-term liabilities and plus other non-operating liabilities, and we from this we minus the amount of cash and its equivalents. Then the fundamental goal of management, so we would have studied in this goal of management, is to maximize the value of the shareholder or maximize the value of the firm and create value for the shareholders. This is the fundamental goal of management. So estimate of the true worth or fair market value. So we call it as a fair market value of an enterprise. It is required by shareholders, tax authorities, regulators, corporates. So all of them want to know whether suppose a company is taking over another company, is there not any underhand dealings? The tax authorities want to know, is there any underhand dealings between these companies so that fair value is not reflected here? So tax authorities, regulators like SEBI and RBI and other corporates trying to take over the company, they all want to know the fair market value of the company. So we know that there is a firm called Ranbaxy. I think all of you would have heard about this Ranbaxy medical company, pharma company. It was taken over by by JAIIB, the Japanese company. Then after taking over by this Ranbaxy, JAIIB found that the Ranbaxy promoters actually hid something from them. So they felt that the value paid by them was in excess of the true worth of the company. So all these problems come later. So a company taking over another company, it wants to estimate what is the fair market value. And similarly, shareholders also want to know what is the fair market value of the company. Tax authorities, regulators, all these people want to know the true worth or the fair market value of the company. So approaches to valuation. So first objectives of valuation is estimation of the true worth of the company in the current market environment. So we know what is the current market environment, what will be the true worth of the company. So we know that the stock market sometimes overvaluation of the company takes place when the economy is booming. So now we know that from 82,000 onwards, the Sensex has dropped to 75,000. So that means that the market valuation of the company has come down drastically. So we want to know what is the estimation of the true worth of the company in the current market environment. So IBS 105, please remember MC for MCQ. IBS 105 or International Valuation Standards 105 says that valuation approaches and methods should be pertinent and appropriate. So it does not say which method to use, which method should not be used. It does not recommend any method, but only it says that any method used by the valuer should be pertinent and it should be appropriate for the valuation. So these are the only two conditions put forth by IBS 105. So International Valuation Standards is by the again organization which puts the valuation valuation of some companies, etc. So they say that the company which is taking over is or the analysts which are analyzing the company, they are free to use any type of valuation approaches, but they should use it consistently and it should be appropriate for the particular company. So that is what they say. They don't say they recommend any particular particular view or particular method. They don't recommend. There are three main approaches to valuation. The first is called the market approach. So prevailing rate in the market for comparable assets. The problem here is whether we can compare for some of the assets, it can be compared. For example, we can compare, let us say, let us say you are living in Bangalore or Hyderabad. So you are going to purchase a 3 BHK home. Let us say, used home or second-hand home we are going to purchase. So we want to know what is the rate which is at which it is selling in the in the locality. So so let us say 3 BHK is selling at, let us say, 1 crore or 120 lakhs it is selling. Suppose we are going to purchase a similar property, but it is a 2 BHK property, then we will say that 120 by 3 into 2 or something, we can say some 75 to 80 lakhs may be the reasonable valuation for this particular asset. Unfortunately, this type of comparison can be done only for house, land, etc. But in case of factory or other assets, this approach may not hold good. So prevailing rate in the market for comparable asset, we call it apple to apple. So comparing apple to apple, not comparing apple with oranges. So the size, quantity, quality, other characteristics of the assets are taken into consideration for comparison. So the second approach is called the income approach. What we have already seen, that present value, you would have already seen present value of the future expected future cash flows discounted at the rate of capitalization. It gives the present value of the expected future cash flow stream. So this is the income approach. So first approach is market approach, where we compare the asset with the comparable asset available in the market. We take into account the size, quantity, quality, etc. And then we finally come to a conclusion. So how much we can pay. So in the income approach, what we do, we present value of the expected future cash flows are net operating income is divided by a rate of capitalization. So we call it as a discounted cash flow approach also. This you would have already seen. Then the third approach is called the asset-based or cost approach. It considers the net asset value of the business by combining the fair market value of its net assets. When we say net assets, net fixed asset equal to fixed assets plus net current assets. Net current asset is nothing but the current asset minus current liability, what we call as NWC, net working capital, minus long-term debt. So why we are reducing the long-term debt from here? We are taking the asset side, we are taking net fixed assets plus net current assets. We have told current assets minus current liability. Suppose let us say this is the liability side and this is the asset side. So in the liability side, we have we have capital reserves, etc. We have capital reserves, etc. Then this is called the net worth of the, we call it as a net worth, capital free resource. Then we have what is called the long-term liabilities or long-term assets, long-term debt. Then we have short-term liability. So here this is, we call it as a current liability and provisions. So this is the liability side of the balance sheet. So for the asset side, we have fixed assets. Then we have what is called the non-current asset or investments, etc. Then we finally have a current asset here. So here what we have done, fixed assets we have taken into account. the current assets minus current liability we have taken. So why from here, why we are this long-term liability, why we are trying to reduce here? Any reason? Yes, friends. Why we are reducing the from the long-term net current assets? Already we have current liability, we have already reduced here, current assets minus current liability. So here again, why we are reducing the long-term liability is my question. Long-term debt. Fixed assets are created mostly through long-term debt. Suppose, suppose let us say, one machinery is there. We are purchasing through a term loan from a bank. So when we take the machinery value, we have to pay off the outstanding term loan to the bank. So without paying the loan. Yes, Madhavan. So liability side, I think JAIIB itself you would have studied. So liability, first one is net worth, current asset. This is capital plus reserve. We call it as a net worth. Then second one is called the long-term liability, that is payable over 12 months, more than 12 months. Then we have current liabilities and provisions. We have in the current liabilities and provision, bank OD or OCC, SEC limit we have. Then we have the sundry creditors, then outstanding wages, etc., outstanding bonus, outstanding dividends, etc. All these are called the current liabilities and provisions. So all these put together. So in the asset side, we have fixed assets, non-current assets like investments in sister companies, etc., investment in shares, etc. Then we have current assets, which are, which will be converted into assets within cash into within next 12 months. Then we also have what is called the intangible assets. So intangible assets are also there. So for our discussion, we take into account fixed asset we have taken. Non-current assets we have not taken into account. So these are investment in securities, etc. So this is created with cash, etc. Then we have current asset. Other current assets we have the cash and bank balance we have under current asset. Stock of stock is there in the under current asset. That debtors will be there in the stock, the current assets. So all these are part of the current assets, which will be converted into cash within the next 12 months. So for what we are doing, the fixed assets we have taken. So fixed assets are created out of long-term liability or long-term debt. So what we are doing from the fixed assets, we are reducing the long-term debt. So we get fixed assets minus long-term debt. Then net current assets, again current assets minus current liability. So this is called the net fixed assets. So it considers the net asset value of the business by combining the fair market value of the net asset. So I will summarize again. So a friend told that I'm going a bit fast. So corporate valuation is the process of determining the value of a company, mainly for mergers and acquisitions. Whenever a company wants to take over another company, it wants to know whether the price paid for the company, whether it is it reflects the true worth of the company. So that is the main purpose. But other stakeholders like shareholders, bankers, then income tax authorities, GST authorities, etc. And the company which is taking over another company, all are also interested in determining the value of a company. So types of valuation, it is a book value and market value. In the book value, we take into account what is the value in the books of the company or the balance sheet of the company. Whereas in the case of a market value or equity value, first we call as equity value. Equity is nothing but equity shareholdings. So we multiply the number of equity shares with the market price of each share, which is called the market capitalization. So this reflects only the equity value of the company, but there are other items like enterprise value includes not only the equity value, but includes the amount of short-term and long-term debts or short-term and long-term liabilities, plus current portion of the long-term debts, plus preference securities, preference shares, plus other non-operating liabilities. There may be other liabilities to outsiders, etc. From this, we minus the amount of cash and its cash equivalents for the simple reason that taking cash and its equivalents again will result in double counting. So the current portion of long-term debts are created out of the cash and cash equivalents. So for that reason, we are reducing the amount of cash and cash equivalents. So up to this, any doubt? Say there is a term loan taken from the bank. The repayment is for 7 years. So let us say EMI for this is now let us say they have taken on the, for our simplicity, let us say they have taken on 1/4, let us say 2024. Okay, let us assume that they have taken a loan for, let us say, 100 lakhs. It is repayable in 7 years EMI. Let us assume that each EMI, I am just giving hypothetical figures, may not be correct. So let us say some let me say some 70,000. Let me say 1,30,000 is the EMI for, let us say, 84 months. So 1,30,000 into 84. So this year, let us say the financial year 2024-25. So for the financial year 2024-25, this is 1,30,000 will into what will be this year's portion. So what we are doing, this is let us say 15,60,000. This what we are doing from the liability at the end of the March, 31st March. We are reducing the liability from the term loan and we are taking to the current portion because it is payable during the year. So only it is an accounting adjustment. So the fact remains that they have to suppose, let us say, some, for our example, let us say some 80 lakhs is still remaining. Then what we are doing is only accounting jugglery we are doing. So from this, from outstanding liability, we are reducing this current portion and we are taking it to the current liability portion. Is it clear now? Any doubt? Anybody else? Again, what we are doing in the term loan, term liability portion, what we are doing, what is going to be paid within the next 12 months. We are separating from the, deducting from the long-term liability and we are taking to the current liability. Current liability is liability which is payable within next 12 months, within 31/3/2025. Is it clear, friend? Still you have a doubt?
No, sir.
No. So what we are doing here, here in this case, it doesn't matter. But as I said, it is only for accounting purpose. What we want to know what is the long-term liability, what is the short-term liability. So here again, if you see short-term debts and long-term debts, we are taking both. So in case we have taken the current portion of long-term debts, it is under the current liability and provision. What we are doing, again, we are adding back. That's all. So simply what we can say, instead of this, simply we can say, we have to take into account the equity value plus the short-term liability and the long-term liability and also preference share capital we have to take. And any other non-operating liabilities is there to be paid to outsiders, that also we will take, minus the amount of cash and cash equivalents. Okay, friend. So as you said, there is no, actually materially there is no difference between saying that short-term and long-term debts separately and current portion of long-term debt separately. There is not much difference. What we are here doing, only one thing is doing, what we are doing is total liability side, we add everything. Equity value from the market value of the market capitalization we are adding. If it is a preferred securities is there, here also market value of the preference share capital we are adding. We are adding long-term debts and long-term, current portion of long-term debts. From this, we are reducing the amount of cash and cash equivalents. Are we clear? So nothing here. So in effect, it means that short-term liability and long-term liability. What we are separately, we are saying current portion of long-term debt. So the fundamental goal of management is to maximize the value of the firm and create value for the shareholders. So estimate of the true worth or the fair market value. We want to know whether we are paying. Suppose we go to, let us say this is similar to going to a shop. Let us say 1 kilo apple is 1 kg apple, we know. Suppose we want to purchase 1 kg apple. We go to some shop. He says that this is a Kashmir apple or some Canara apple. He says that 300 rupees is the kilo value for this 1 kg of apple. So what we will generally do, suppose you go to a shop and purchase something like this, where there is no MRP, we will bargain or we will want to know whether we would have gone to other shops, etc. Or we know from the newspapers, etc. The apple is, this particular apple is selling at 300 rupees. So bargaining is not possible in all the shops. But we suppose while purchasing, we would like to know what we are paying is the fair value for the asset purchased. Here also, one company is purchasing another company. It wants to know whether they paid a fair market value. And also why income tax people, tax authorities, why they are interested here. So one company is taking over another company. So what difference it makes to the income tax authorities? Suppose they have to pay tax on that. The income tax authorities want to know, suppose the price is 100 crores. Suppose the company is paying only 70 crores on the book and 30 crores black they give. So we know real estate it happens. So here the company wants to, tax authorities want to know whether the fair market value is reflected in the purchase price so that there is no tax evasion. Similarly, regulators, they also want to know there is no, bending of any laws and regulations, etc. And they generally are the one corporate trying to take over another corporate also if it wants to know whether it is a fair price paid to the company. So I cited the example of Ranbaxy hiding something from Daiichi who purchased that. Then afterwards there was a legal battle going on. So the company wants to know for sure whether the price paid is a fair market value for that. So this is called the enterprise value, or enterprise value is different from equity value. Equity value talks about only the share, shares or equity shares, whereas enterprise value takes into account equity shares value, market price, plus plus the preference shareholding, plus long-term liabilities, short-term liabilities, other non-operating liabilities, etc. From this, they reduce the amount of cash and equivalents.